Did you know 90% of Americans can't afford the cars that they're driving? With many car loans now over $1,000 a month, the average transaction price over $50,000. We talk about repossessions. They're up to almost 7%. That's 1 in 12 vehicles are virtually going to be repossessed. After a 60-day period of not making payments, they wave bye-bye to their car. And with interest rates now climbing, with rates in that 6.5% to 7% for new vehicles and used vehicles at 10.5%, 11%, or subprime buyers borrowing money with interest rates that are up at 24%, 25%, people literally can't make their payments. While the average income of the average American household is in that $70,000 to $80,000 range, you look at the sheer price of these vehicles now at $50,000, $60,000, $70,000, it's no shocker why people are unable to buy these. I'm going to share some of the great rules of thumb, some ways to proceed with buying a car and making it affordable, because let's be honest, it's heartbreaking, it's heartaching. People wake up in the middle of the night to find their car being towed away by the repo guy. Most people assume that the big expensive supercars, luxury cars are the cars in fact that are getting repossessed at an alarming rate. Yeah, you'd be wrong, because actually most of those cars are lower down on the list of vehicles that are repoed. In other words, most of the people that can afford luxury vehicles, exotic cars, and premium vehicles are people, in fact, that have the better rates. They have the better credit, and they're able to afford those vehicles. And less of those people are considered prime borrowers. In other words, they're going to get better rates. They're more affordable. They're able, in most cases, either to buy it cash or pay it off within 3 years. Affordability is a conversation and a challenge that we're all faced with today. Nothing's getting cheaper. We're talking about inflationary rates that going up 2%, 3%, 4% a year over year, every year. Not everybody makes that difference. Not everybody makes that amount to compensate. The amount that most people are making in the household today loses ground every single year. But that's the exact reason why it's more important to look at today, what you're doing today, so you set yourself up for success in the future. Because it's not going to get easier, but it can. And I'm going to explain how.
Life's too short to drive boring cars.
The highest risk tends to go with pickup trucks. Why? Have you seen the price of some of these trucks these days? $70,000, $80,000, $100,000. We've even seen a tungsten ram now here in Canadian dollars for $130,000. Mind blown. How did that even happen? How did we get to a place where a pickup truck mere a dozen, 15 years ago, a fully decked out 4x4 crew cab truck that you could get for $35,000, $30,000, and now we're staring down the barrel of over $100K. How did we get here? So that's where a lot of these vehicles are now higher risk. We're looking at full-size trucks like the F-150 and Silverados at some of the highest risk vehicles. Vehicles that have high loan values, strong auction demand. These are all classic draws, and people like to get trucks. I mean, how many people have you heard got a job on the rigs? You know, a young person comes out of high school, they go out there, naturally, they get their first high-paying job. They go out there, they say, look, oh wow, I'm making $6,000 a month, $7,000 a month. So they come back at the next turnaround, they decide, I'm gonna buy this new truck. I can afford it, no problem. The bank says, the loan to value, hey, you're golden, right? They ultimately say you've got 46% of your budget well covered. No problem. You're making all this money because the banks are saying you're good up to 46% of your debt. And all of a sudden, some young buyer says, you know what? I'm now making $6,000 or $7,000 on the rigs. Now all of a sudden they have all this money and they think they have this budget. But see, that's the problem. And a lot of people get snookered. They get screwed. They think that, you know what, my monthly budget, I can sustain that. But what they don't think is overall affordability, because there's some other major factors. It's more than just your monthly payment for that vehicle. First of all, we know the banks, we know the car institutions are some of the biggest weasels in trying to get you into a car. You want it to have that car paid off quick? Well, the banks are saying, look, we can make that vehicle happen. You can't afford it in 3 years, but what we'll do, we'll give you a loan payment that's going to be $1,000 or $1,500 a month, well within your 46%, but we can do it in such a way that we'll just spread it out to 8 years. No problem. You got that covered? Of course, you're all excited, bright-eyed and bushy-tailed, and a lot of those people go out there thinking, hey, my new job, I'm young, I'm healthy, I can afford this. Yes, I want that new truck. The problem is, A lot of people take out these long loan terms, and that introduces high risk. That job goes away, you've got to go somewhere else, you get hurt. Now you're at home on Pogie or some other means, or you're not making income at all of a sudden you default and the truck goes away. Other changes, of course. You all of a sudden decide, oh, scramble, I've got to get out of this. 3 years in, you're deciding the warranty's gone, this is too much risk, complicated vehicle, we're hearing all these recalls and failures. You're stuck now trying to trade that vehicle in, maybe downsize, trying to get ahead of the game. Did you realize that the amount it depreciates starting at 11% from the moment you drive it off to the time 5 years later it rolls around, that vehicle's lost 50 to 60% of its original value. So 3 years in, you're at probably 30, 40% gone. You're underwater. You could trade it in, but now you might even have to top up an extra $10, $15, $20,000 to cover the difference on the loan that you originally took in the first place. That's right, a lot of people suffer negative equity, and this is another classic symptom of people spending more than they actually have. Full-size trucks are some of the riskiest buys. Second to that are economy cars, vehicles like the Corollas and the Civics. Yes, small, affordable cars, the Camrys. We're seeing even Toyota Highlanders and vehicles that you would consider easy peasy. They're not that expensive, but guess what? Those are some of the highest risk buyers. Many of the buyers looking for those lower cost entry-level vehicles buy them because of high incentives, volume buys. Some of these manufacturers are offering easy buy-in options. Of course, interest rates are relatively low. They're safe buys, and they're buying under the pretense of a 7 or 8 year car loan because they don't have the credit score. They don't have the money, the income, but a lot of these lenders are allowing them to buy them by extending out the loan term, and that's how people are getting screwed. Something changes, they lose their job, they get sick, all of a sudden they have to trade it in. Next thing you know, they're underwater, trading it in, or the repo man showing up at their door. Some of the new cars, we always know depreciation is the biggest factor. Where the average new is about $50K, the average used is $26,000. Now, unfortunately, that's not a cheap amount of money either, and the risk is, with a used car, you're further down the line, you have likely less warranty or no warranty at all. On top of it, you're paying higher interest rates because most banks and lending institutions don't want to cover that amount. So how do you get around that? Pay cash. As they say, cash is king, and that's something that I live by. And a lot of the vehicles I've purchased over the years have been done by incrementally increasing. I want to buy a supercar. My first supercar was a Lamborghini Gallardo. That's a classic example of a car you're not going to lose your money on. See, I bought the car. It needed a little bit of loving, but I was able to see past the fact that it needed some refinished wheels and it needed a little extra paint protection film. I got those things done for a song and a dance. I bought my Gallardo for $94,000. It was a 2005 with very low miles on it. I drove it for about 7 years. I did the PPF. I did the wheels. I even put a Tubi exhaust system on it. I drove it for 7 years, did a little bit of maintenance on it, and all costs added in. 7 years later, with the natural increase in value of those cars, I actually got out of it and I made a couple $1,000s. Go figure. Audi R8s, early generation, also cars that are going to potentially save you money. Not everybody has that money. That's fine. Another place I found vehicles that tend to hold value are some of the older trucks that are well kept, well looked after. General Motors, Fords, vehicles, trucks that were well proven, that weren't all loaded up with tech. Think 80s, 90s, 2000 generation. I still have a 2003 Dodge Ram, and I love it because I don't owe anything to the bank. It has old technology, and if something fails, it's not going to burn my shirt. They're easy to afford and easy to own. I've also experienced that with Camrys. I got in and out after 4 years, and honestly, I think I lost $1,200 on that car all in after putting on about 68,000 kilometers. I've got in and out of many cars that are quite honestly lower risk, more reliable, or knowingly the market was strong for. Right now, if you want a supercar, look at Ferrari F430s, a great place to invest some money in. Gated cars like the 360 or early Gallardos with the gated shifters, guaranteed to go up some value. Don't throw money in places on frivolous new vehicles that have loads of new technology and unproven reliability. Those are places you're going to lose your shirt. Thanks so much for all the new members supporting the channel. If you want your own emoji, priority questions, and sneak peek of a new video, or you just want to support the channel, be sure to hit down there, hit that link. That's going to do all the work for you. Thanks again so much, everybody. I want to talk about some other things that people don't take account for. You know, it's not just on affordability and making these car payments. There's other factors, things that many people don't even think about. They think, okay, I can afford that loan payment. Oh yeah, 46%. Remember the bank said I can afford that with all my debt? You you have to think about the other factors, because a lot of these vehicles create other considerations and a lot of people just don't think about it. One, for example, the financing charge. Of course, the more you're paying on interest, the more you're going to ultimately pay. So you want to shorten that up. Think about gas mileage. Gas price right now is anywhere from $1.30 to about $1.80 a liter. Based on the average mileage people put on, 15,000 to 24,000 kilometers a year, or about say 18 to 20,000 miles, you're in a space of spending $2,000 to $3,000 a year on fuel. So think about that, what that can actually end up costing you, a few $1,000s in gas alone. A lot of people don't think about that. Things like insurance costs. Now that's variable depending on your age, your history, the type of vehicle. You know, one of my cars, my Lambo, I was driving that for as little as $1,700 a year fully covered. That's because I had a good credit score, but not just a credit score, I actually had a good accident history. I didn't have any accidents. So they look at me as a lower risk. I was an older driver, and so it didn't cost me as much. But I hear a lot of younger buyers these days, or drivers, spending as much as $4,000, $5,000, $6,000, $7,000 per year for their insurance. I'm hearing even horror stories, people paying $1,000, $2,000 a month for insurance. It's something you've got to pre-survey. Check it out, how much that's going to cost you. It's going to take a major bite out of your available income. Registration, of course, that's part in the US, not so much in Canada, but something to think about. In Canada, you're spending not all that much, but it could be $100, $150, maybe a little bit more for registration, something to consider. What about maintenance? Even if you're in some of these cars these days with brand new vehicles where they're saying, hey, maintenance is covered, 3 years free maintenance. Well, guess what? If you've got a loan for 5 or 6 or 7 years, maintenance costs are going to start rolling in. Sometimes there's those unforeseens, tires, brakes, those are all factors, and those are not covered under standard warranties. So in other words, you will be paying for brakes and tires and clutches and bulbs and other consumables that often are not considered on bumper-to-bumper warranties. It even gets worse as the vehicle's outside of 3 years. Now we're hearing, okay, Ram, for example, is offering up a 10-year engine warranty, but most manufacturers are not going that far. Sure, Kia, Hyundai, only because they have to save face because of all of the failures. Don't forget about depreciation, because every month that goes by, you're losing hundreds, if not thousands of dollars on depreciation. If you're buying a $50,000 car, 5 years, that vehicle's worth $20,000. You've lost $30,000 on depreciation in that time frame. So that all has to be taken into account. And the worst part is, a lot of people don't even want to buy a vehicle outside of warranty, so they continue this trend. They buy a car, get in a long loan term for affordability reasons because they can't afford the expansive amount. So they say, okay, I can't afford a 3-year loan term, so I need to do it over 7 years. Now you've got negative equity, depreciation enough to choke a horse, because you're one of these people that assume that I can't afford maintenance and repairs on an older used vehicle. This is why, in fact, one vehicle in that entire time I bought new. Every other vehicle I bought, the sweet spot for me was 3 to 5 years of age. Many of my vehicles were luxury vehicles, BMWs, Mercedes, Audis, Porsches. I've driven a lot of these cool cars because I'm a car nut, and there's just some things us car nuts love, right? We love driving some of these cool cars, but I buy it in a way that it's depreciated. 30, 40, 50% of the value gone. That's when I sweep in there. But I also ensure that I put enough money away as a budget to allow for unexpected repairs. See, because remember, instead of buying that C-Class Mercedes-Benz for $70,000 new, I'd rather come in and buy it for 25 grand at 3 years of age and put a few dollars away. Even if there's a failure, I'm going to be okay. Yeah, you'll have issues, maybe a cooling line here, a radiator there, or a starter there, but that's a far cry from that $40,000, $50,000 differential, isn't it? So now you have a lot of repairs in there that you can cover. But for those that like to believe and they can't wrench and they don't want to take too much risk, there is a rule I call the 23-8 rule. 20% down. If you can't afford a 20% deposit, if you go and you're making, $15 an hour and you're looking at this $100,000 car, you can't afford to put 20 down, you can't afford the car. It's as simple as that. And it's a hard pill to swallow, but it's one that I believe in thoroughly. Three is the 3 years max. If you can't afford to pay off that loan term in 3 years, you probably shouldn't buy that car. And the reason for that is, if you've got a shorter loan term, like a 2 or 3 year loan term, what that does is it reduces drastically the amount of risk. Of course, less chance of something with your job or job loss or a problem with the vehicle. You're probably still going to be within a new car warranty program. You're going to have less interest charges incurred. So you're not going to be paying as much interest charges back to the bank. That sounds like a win to me. And that's the way I have always played my game. 8. That's maximum 8% of your gross income. So if you're exceeding 8%, some people say as much as 10%. So if you're making 50 grand a year, 5, that's the number, right? These are all factors that you have to be thinking about. From my perspective, I like to pay cash. I like to write a check and be done with it, because then that allows me to put that money in other places. I always budget a little bit, put a few grand, have a little bit of a $10,000 float for some repairs should they come up on some of these vehicles. I love driving luxury cars and some of these exotics, but if I don't have some money in the bank to prepare for these unexpected breakdowns, then I can't afford the car. That's the way I see that. Remember, at 3 to 4 years old on luxury brands, you're usually saving 40, 50%. You know, our E60 M5 that I lusciously love to this day, we bought it from the original owner, and that car was absolutely amazing. I love it, and I still love it. We still have it. It only has 58,000 kilometers on it because it's a toy, so it sits there. Brand new, that car was $138,000 Canadian. Black sapphire metallic, the upgraded interior with the aluminum trim. We have the heads-up display and the active bolsters. 507 horsepower SMG. Beautiful car. We paid $38,000 for it, and it had 25,000 kilometers on it. How is that for a steal of a deal? My Jag F-Type, same thing. It was a 2018. I bought it 3 years old back in 2020. I paid $75,000 Canadian for it. I sold it 4 or 5 years later, and I actually came out pretty much even Steven. After owning it for 4 years, and I put on about 40,000 kilometers on it, enjoyed the out of it. These are examples of getting in, getting out, but making sure you get a strong deal on the front end, not overpaying. Who cares about the ballers? Who cares about trying to look like everybody else and trying to compete with the Joneses? I love my luxury cars. I love my exotics, and I will continue to drive those cars. I truly believe life's too short to drive boring cars. I'm not rich. I've always been a middle-class dude making middle-class money, and I've never had a ton of money, but I've just found ways to stretch it out. The best way to get in and out of a car, not spending all your money, is to hold on to it. So if you're going to buy that car for $50,000 brand new as the average transaction price today, hold on to it for 10, 12, 15 years. That's why you should be choosier in the vehicle you buy. For the amount you're going to lose on depreciation, $10,000, $15,000 year over year on a brand new $60,000 or $70,000 truck, that amount of money, I can buy a $6,000 or $7,000 used beater. You know, you need to put a starter, a new pair of tires on your old truck. Who cares? Okay, you pay $1,500 for a new set of skins. Does that really matter? Not really when you know you're saving that much. A vast majority of people right now just worried more about the image. For me, I don't care if I drive a 7-year-old luxury car. If it's reliable and I like the way it feels from the driver's seat, I'm buying it. I'm good. I love driving fun cars. I love enthusiast cars. And I mean, ultimately, that's what makes me tick. But I don't have to do it and go broke doing it. I hope that really helps you to understand where I'm coming from. You can have your cake. You can have your dream car, but don't go broke doing it. Well, please do check out that video right there. And these. Hope to see each and every one of you real soon, everybody. Bye-bye.